Roach, what a delight to have you on ET Now. Thank you for joining us.
It's always a pleasure.
Mr. Roach, let me start with something which is of immense market curiosity. Is Greece going under?
Greece will certainly have to take a haircut on its rapidly expanding burden of sovereign debt. That means restructuring or a technical default. They're trying to defer that for as long as they can, but given the debt trajectory of this small country and the lack of indigenous manufacturing capacity, the likelihood that it will be very difficult to implement the fiscal austerity given the social backdrop in Greece, I think some restructuring or default is inevitable.
Is Spain and Italy a bigger problem than Greece?
Probably more worried about Spain than I am about Italy because of the very high unemployment in Spain, especially the 43% youth unemployment in the country. Spain has a very credible package of deficit reduction over the next 5 years, but it's credible only in the event that the population is willing to take on the sacrifice of fiscal austerity and a contraction of aggregate demand. And up until recently, the Spanish government drew great comfort from the fact that the population was relatively passive in expressing displeasure over high unemployment. But that's pretty much over now. There are fairly significant outbreaks of social protest in the major cities and even some of the smaller cities of Spain. It's going to be very difficult for Spain to do what other overly indebted countries do, and that is cut back excessive budget deficits and restrict aggregate demand.
So could EU completely go the Fed way, which is they will be forced to print money?
The ECB will be, and the EU in general, will be in a lot of trouble if the contagion spreads to the larger economies, Italy and Spain. It's one thing to deal with small countries like Greece and Ireland and Portugal, but these big countries, as someone cleverly said, it's not that they're too big to fail, they're too big to bail.
Has QE2 failed, Mr. Roach? Because QE2 ended up just fueling asset price inflation.
Well, you know, it depends on who you talk to. If you talk to the central bank in charge of quantitative easing, they'll tell you it was a terrific success. If you talk to American workers who were supposed to benefit from this extraordinary monetary stimulus, they'll tell you it was an utter failure. I side with the people. I think QE2 was poorly designed, ill-conceived. It was just another effort at sustaining the policies that did work very successfully during the crisis when you needed a lot of liquidity to stop the markets from crashing. But what worked in the crisis has not worked in sustaining a meaningful recovery in the real economy or, most importantly, in the U.S. labor market. QE2 did nothing that led to a meaningful improvement in the U.S. labor market.
So is a QE3 coming soon?
I think the Fed is very unimaginative here. They do believe that they have lots of discretion as a monetary authority, even with interest rates, their policy interest rates at zero, to provide further stimulus to the economy. And I think they're completely wrong in that respect. They can inject liquidity, which can boost financial markets, but the transmission mechanism between the financial markets and the real economy has really been severely impaired by the post-bubble damage that's been done to the American consumer in particular. American consumers are cutting back on spending. Over the last 14 quarters, U.S. consumer demand has grown at an average annual rate of just 0.5%. That compares with a pre-crisis trend of close to 4%. The consumers are determined to pay down excessive debt, rebuild inadequate saving, and will do that even if Mr. Bernanke injects liquidity and tells them to do the opposite.
Do you think the Fed or U.S. central government is getting a bit worried about commodity prices because for the first time in the last 15 years, the IEA has moved?
I think there's a little bit of a concern, but I think it's less of a concern about commodity inflation turning into broad-based inflation and more of the fact that oil prices are a tax on the American consumer. I think Washington wants to do everything in its power to provide some type of stimulus to U.S. Consumers, and of course, this release from the Strategic Petroleum Reserves has really not accomplished that at all. Mm-hmm. It's small, and it's a transitory stimulus at best.
Have U.S. Housing prices bottomed out? Because that really was the biggest evil in 2007 and 2008.
I don't think U.S. housing prices have bottomed out. I think the worst part of the decline is behind us, but there's still an awful lot of supply that will be coming into the market as an outgrowth of foreclosures from property whose owners are underwater in terms of their equity. And I think until we clear up this overhang of potential foreclosures, there'll still be some further downward pressure on U.S. housing prices.
Do you see United States government or U.S. losing its AAA status?
I think we're at a dangerous part in this political circus associated with the debt ceiling. I suspect we will go down to the wire or to the last minute before a deal is done between the Democrats and the Republicans. I think the only thing that both parties seem to understand is that a default on sovereign indebtedness in the U.S. would be a catastrophic development for the United States and for the global economy.
But if America loses the AAA status, do you think Chinese will stop buying U.S. Treasury bonds?
Well, number one, I don't think we'll lose our AAA status because I think a deal will be done. If we wait too long, there could be a temporary downgrade until a deal is done, and that might be another way of putting pressure on Washington. I don't think China is going to sell its treasuries. They're not prepared to do that and take on the risk that would be associated with that, which for them would be considerable, and that would mean a sharply higher renminbi versus the dollar. China still depends heavily on a managed currency to underpin its export-led piece of its growth equation, and selling treasuries would have ominous consequences for that.
At these levels, are you bearish on U.S. Treasuries or reasonably optimistic on U.S. Treasuries?
You can make either case. All I know is, certainly if we have the risk of a debt default get priced into the market, Treasury yields will back up. But again, this would be a temporary development. The one thing I remember from the 1990s is that there was an overwhelming consensus amongst the smart money managers that the most obvious trade that needed to be put on was to believe that Japanese government bond yields were going to go up. And all the smart money guys sort of lined up and bet on this trade, very much like you're hearing a lot of the talk against treasuries. The last time I checked, yields on 10-year Japanese government bonds are lower today than they were in the 1990s. And so the lesson here is in post-bubble economies where a lot of balance sheet damage is done, long-term interest rates can stay a lot lower for a lot longer than many people think.
Are you a dollar bear for next 5 years?
I've been bearish in the dollar since early 2002. It's the right bet. It's mainly been an outgrowth of my concern over America's lack of savings and the associated current account deficit that's come from that. I'm afraid I'm still not optimistic on the long-term prospects for U.S. saving, especially given the budget outlook in the United States. It's hard to be optimistic on the U.S. dollar in that environment. Do
you see euro collapsing or euro will survive?
I think the euro was always a political contract, especially between France and Germany. I think the political will to sustain that contract remains very much intact. But I do believe that the euro itself was an outgrowth of a flawed currency union with a unified monetary policy but a fragmented fiscal policy. And for the euro to regain its its prominence as a major currency in the world, the lack of focus on fiscal unification needs to be addressed, and needs to be addressed urgently.